Hello, this is Dean Malone with Compass FX. This video is about trading the bank trader strategy using a position trade style. There are 4 determining factors to trade the bank trader strategy: technical market bias, and then the trade style. In this video, we'll focus on the position trade style. When using the bank trader strategy with a position trade style, position trades with above average pip count can be achieved by targeting weekly high or weekly low targets from the open of the week, or on a break of the previous week's high or previous week's low. Use the previous week's high and low to trade breakouts and/or continuation and reversal setups to weekly targets. It is recommended to use the 1-hour or 4-hour chart to monitor and trade the weekly levels. When trading with a position trade style, realize that trades may take 1 to 4 days to complete. When using a position trade style, let's consider the variables of market bias. The long bias: if the market trades above the open of the week and breaks the previous day's high, that's a long bias. A short bias is when the market trades below the open of the week and breaks the previous day's low. The short reversal bias is if the market breaks the previous week's high, then retraces and holds below the previous week's high. Look for a retest of the open of the week or the weekly midpoint. The long reversal bias is if the market breaks the previous week's low, retraces, and holds above the previous week's low. Look for a retest of the open of the week or the weekly midpoint. In this example of a trend continuation position trade, we see that the previous week had an uptrend, and at the open of the week, price continues to rise higher. You can enter a long on the bounce of the open of the week when the market tested the open of the week, and then target the previous week's high. When price tests the previous week's high and moves higher, then look to exit the trade at the weekly high targets 1 or 2. When considering a trend retracement, look to see if the market opens up near the previous week's low or the previous week's high. Oftentimes we've seen that the market will literally retrace back halfway or all the way if the market opens up at the previous week's high or low. In this example, we can see that the market opened up near last week's high, tries to push up just a little bit but cannot, and drops below the open of the week. You can enter a short trade as price drops. We look to target the previous week's low, especially when the market comes down to the weekly midpoint and drops below the weekly midpoint. And then we can exit our trade at the previous week's low or at one of the weekly low targets. In this example, a potential exit at weekly low target number 1. Then there is the weekly breakout. This is an easy type of technique. We're simply looking to trade the break of the previous week's high or the previous week's low. In this example, we can see that price was moving inside of a range in the previous week. At the open of this week, we see that the market had pushed up to the previous week's high but could not break it. The market does a retracement and trades back down to the previous week's low. Now this offers the opportunity to do a trend retracement trade. What I'm looking at here though is the break of the previous week's low. So we can enter a short trade at the break of the previous week's low and then look to exit at the weekly target number 1 or the weekly low target number 2. Looking at this example, give consideration that in a trend retracement, there is the prospect of adding to your position on the break of a weekly high or weekly low. In this case, you could have taken a trend retracement trade from the previous week's high, traded that down to the previous week's low, then on the break of the previous week's low, add to your position and trade both positions down to the weekly target number 1 or weekly low target number 2. Let me share with you a few trading tips when you position trade. Number 1, consider the high of day and the low of day. The placement of high of day and low of day compared to the previous day's high and low can have an impact on the potential direction of the market. Let's take a look. An uptrend continuation, the market is in an uptrend. and the low of day is higher than the previous low of day, there's the potential for continuation of the uptrend. Whereas in an uptrend reversal or retracement, we can see that the market's been in an uptrend, but the high of day is now lower than the previous high of day, suggesting a retracement or reversal. Remember, a retracement is typically because of profit taking in the market, whereas a reversal is a shift in trend direction. A downtrend continuation is when the market has been in a downtrend and the high of day is lower than the previous high of day. Then we have the downtrend reversal or retracement. This is where the market has been in a downtrend and the low of day is higher than the previous low of day. Another trade tip is to use the average daily range as a favorable target. Add it to the low of day or subtract it from the high of day. Many traders use the average daily range over the week or over the month. Use an indicator such as the Traders Dynamic Index to determine market sentiment and confirm price action. So if we're in an uptrend, we need to have the Traders Dynamic Index or other oscillator also suggesting that the market's continuing to move in that direction. One other trade tip is to look for a 23.6 or 38.2 retracement. If the market does not retrace further, this is a good indication of a trend continuation. Another trade tip is to consider the range high and range low targets. These targets are highly probable if the market repeats the previous daily range. Well, this concludes this training of trading the bank trader strategy using a position trade style. Make it a great day and get some good trades.